the financial documentation provided to governing body members. Sorry, just 1 second for me. Wherein we unpack financial documentation provided to our governing body members. We trust that these webinars have and will assist our governing body members to better understand the financial documentation that are essential to the effective financial management of your schemes. For those that may have missed any of the Bellboy webinars, for your convenience, these webinars have been uploaded to our Facebook page. Please like and share these webinars with your community scheme members. As a reminder, the following webinars are available on our Bellboy Facebook webpage, namely the Craig Jessup BBV attorneys on labour and health and safety, Sally Roberts, Ordell Brokers on insurance, Jason on management accounts, Hayden Dupree, HTP accounting on scheme audits, and today's webinar on scheme budgets will be uploaded following this webinar. It again gives me great pleasure to formally introduce our presenter, Jason Wallace, who will be presenting today's topic on scheme budgets. Jason Wallace joined Bellboy in 2012 and is Bellboy's operational and financial manager. Jason started his working career teaching computers, mathematics, and accounts to high school students before going into the private sector, where for the last 17 years, he has primarily been in the financial division of community scheme property management companies. Jason is studying towards his BCom degree in financial accounting and is now in his final year. Just again, some housekeeping before we get started. If you have any questions relevant to this presentation, please type your questions into the question box in the Zoom control panel. As time permits, we will put as many questions as possible to Jason. Any questions that we are unable to answer, we will respond to following this webinar. There's quite a bit of content to go through, so without any further ado, Jason, I'm going to hand over to you. Thank you.
Thanks, Chantal. I'm just going to share my screen here. There we go. Is it showing on your side?
Yes, it is.
Okay, great. Okay, so welcome everyone. Like Chantal says, this is the webinar on understanding community scheme budgets. The topics we're going to cover today is going to be the levy and insurance schedule that's sent out in the budgets, the budget sheet, and the reserve fund and fidelity cover at the end. And I'll be explaining how those calculations are done and what you need to look for. As always, we will try and cover as many topics as we can and try and cover homeowners associations, section title schemes, and some of the differences there. Okay, so we'll start with the levy and insurance schedule. Top left-hand corner, you've got your scheme name, SS number, and then your CSOS registration number. CSOS came into effect in 2016, so your registration number will be the year that it was registered, the area, so in this case is Eastern Cape, and then the number that you were registered in. So if you were registered in 2017, it would say 17 Eastern Cape, and which number scheme you were registered in that year. Contribution insurance schedule for the period, then we say the budget period, which is being tabled. Usually that'll be a year unless there's a mid-year change in the budget. And then a resolution as per the trustees resolution, or it'll say governing body or directors if it's homeowners associations, etc. And the date that that resolution was undertaken. If you're a trustee, the date, and it's a proposed budget, it won't have a date yet until the trustees approve the budget, after which we'll insert a date in there. Okay, so the levy schedule then goes on. You've got your door number, you've got your section number, the area of the unit's PQ, and then the units, and then the actual levy. So the levy will be calculated taking the PQ of that unit, multiplying it by what is required to be raised to get how much that unit is going to pay. And in the same instance in this example, there's a garage, so it'll say the garage section number, what its area is, and then what that area relates to in terms of its PQ, and then again it'll take that PQ value, multiply it by what needs to be raised for the scheme for the year to give you how much is required, or how much that garage or that section is going to be required to pay. And that will be repeated. So if you've got storerooms, if you've got other sections which are on the SG diagram, those will be repeated. So it'll then again say area of storeroom, section number of storeroom, PQ of storeroom, and it will repeat itself along that sheet. Okay, so at the bottom left-hand corner here, you can see it says total area square meters, 718. So that's the sum of the unit area, the primary sections there, together with the garage area. So here it's 82 square meters. You add those, you get the total square meters, which is 718 in this case. If you take the levy which is being raised, so in this scenario, you've got the 3,227 plus the garage levy of 415, you divide that by the number of square meters in the scheme, you'll get a levy rate per square meter, and that can range anywhere from 5 Rand a square meter to 30 Rand a square meter. It's just dependent on the services which your scheme require and how many people are contributing to it and the area of their units. So in this case, the levy rate per square meter for United Villas is 5 Rand 7 cents per square meter. Okay, next to the levy which is being raised, we've actually split this levy up into two. We've said your unit levy whilst, so if we look at unit 1, we're raising 690 Rand for levies for them. We then split this up to show you of the 690 Rand, 516 Rand 69 is for administration expenses, so your operating budget for the year, and 173 Rand 31 cents is it goes towards reserves. So we split the 690 Rand just to show you that proportion. How much is for admin, how much is for reserves? The reason for that is because in our next slide, when we go through to show you how to do the calculation for CSOS, the CSOS levy is calculated on your administration portion. So we need to split this levy up to show you how much you pay for reserves and how much is in the admin portion. So if you look for the reserve portion, the calculation will be as follows. So we will take your PQ, we'll multiply it by the amount required to be raised for reserves in your budget, which you can see here was 915. So we take your PQ, multiply it by the 915, we get that reserve portion. And then the balance of that is your administration portion. If you add those two up, just as a reconciliation, so you've got the 810 Rand 50 plus the 104 Rand 50, it gives you the 915 Rand, which is in the budget. Okay, let's go to our next slide. Okay, so still with the levy and insurance schedule. So we've got our unit levies, including our reserves. So that was the total unit levy. We add your garage levy. We then add any other contributions, whether they be rentals, exclusive use parking contribution in this case. So we add those up and we give you a total contribution for the month. So in this case, for unit 2, their total is 786 Rand. And then going to what I had said earlier with regards to CSOS. So every member in a community scheme will have to pay a levy to CSOS. And the levy is calculated as follows. So if you look just below the table there, CSOS levy, the first 500 Rand per section, there is no levy payable. And then you pay 2% of the administration levy over and above that 500 Rand. Up to a maximum of 40 Rand per month. So if we look at Unit 2 as an example, if we look at Unit 4 as an example, their levy was 1,172. That split was made up of 877 Rand for the administration portion plus 294 Rand 38 for their levy, for their reserve. So we look at the administration levy there. So we take the 877 Rand 62. We take off the 500 Rand, which is exempt or there's no levy payable on it. We get 377 Rand 62, and then we find 2% of that amount, and 2% of that is 7 Rand 55, which is what this unit will pay to CSOS each month. And like I said, this is per section. So similarly, the same calculation will be done on the garage levy. So in this example, though, you can see that the garage levy administration portion in all the cases is less than 500 Rand. So no CSOS contribution will be payable in terms or by those sections because the amount of levy that they pay is less than 500 Rand. Okay, so we continue. We'll continue to move along the insurance schedule. So we got our total from adding up all the amounts that each owner needed to pay, plus the CSOS levy contribution. We then give you a total. So this final total will be the total amount that you would need to pay each month if you're setting up a standing order or a debit order, whatever the case may be. If your scheme doesn't have, say, variable charges which wouldn't appear in the schedule because it would be dependent on your usage. And then finally, the last two columns on your insurance schedule, you'll have your sum insured. The sum insured, again, just like your levies, is calculated by taking the PQ of your section and multiplying it by the total sum insured of the scheme. So in this case, United Villas is insured for 5,744,000. You then multiply your unit PQ by that total sum, and you get how much your unit is insured for. In this case, Unit 1 is insured for 1,088,000. Now, what won't actually show when you get your budget from us is these additional notes here. But these notes are there in order for us to monitor and keep a track. Where, for example, there's been a request. Often we get a request from bondholders to say, or from your bondholder, ABSA, whichever bank it's with, might say at the time of transfer, we require your unit to be insured for a minimum of X amount. So usually we will tell them this is how much the unit is insured for. If they feel it should be higher, then they will request and say, please can you arrange for this unit to be insured for a minimum of X amount. So in this case, it was ABSA. They made a request on the 20th of August when this unit was transferred, that this unit should be insured for a minimum of 1.2 million. So in that case, then there is an additional insurance of 112,000. So that additional insurance of 112,000 is an additional request over and above what the scheme provide. Therefore, that owner will pay a small contribution each month, or a small additional insurance contribution for that sum which their bondholder had requested. And then in this case as well, we've got a specific owner request for Unit 3. This owner has a jacuzzi and requested that the jacuzzi be added onto the insurance policy and insured at a sum of 25,000 Rand. So again, the cost of that insurance for that jacuzzi will be an owner contribution. They'll pay an additional sum for that additional insurance, which is not covered in the normal policy of the scheme. Okay, great. Then, as you saw in this example, we had exclusive use. So in this case, we have 3 parking bays which are given to those owners to use as exclusive use. We've got the area of those parking bays, which is 20 square meters, and a contribution for those parking bays. Excuse me. So the schemes can actually decide with regards to exclusive use. There's a few options that schemes can take with regards to contributions for exclusive use. So if you look at the bottom, I've put the two options here. So the first option, the cost defined in the Sectional Title Schemes Management Act in 3.1c for the exclusive use areas in this schedule created in terms of Management Rule 32 are the responsibility of the owners allocated these rights, and therefore no contributions are reflected. So that's one option. So if dependent on the rules of the scheme can say, okay, we're not going to collect a contribution for the exclusive use area. However, should maintenance be required, or at the time that maintenance is required to that area, you will have the owner who has exclusive use will need to pay for that maintenance at that time. And then the other option, if you look at the second half of that table, it says exclusive use through, and again, it depends on which rule is applicable to your scheme. Exclusive use through conduct rule 1 in this case, exclusive use contributions are calculated at, and in this example, it's 40%. This percentage again will be determined by a trustee's resolution, 40% of the levy rate per square meter. So in this case, if you recall in the previous slide, we had a levy rate per square meter. So the scheme have decided to charge exclusive use at 40% of that levy rate, which works out to £2.03. So you take the 20 square meters, you multiply it by the £2.03, and you'll get a contribution. In this case, it's 41 Rand. So this 41 Rand is paid by these three owners. The total there is 103 Rand, 123. This goes to your budget under income. You'll see that income coming through to say the scheme will receive 123 Rand in income. So this scheme decided, okay, we are going to charge for the exclusive use to these owners. Now the option is, or now they have to look and say, okay, we've raised this amount for exclusive use. How much of it are we going to put aside for maintenance of that exclusive use area, and how much of it are we going to put towards administration costs? So the amount that we're raising, we say it's only fair that they pay a portion of the insurance, they pay a portion of, say, printing and stationery, administration expenses, a portion of the audit, etc. So of that 123 Rand, how much of it should be put aside for repairs at a later date, and how much of it should pay for the administration in the scheme? So in this example, what the scheme have decided is they calculated the administration portion in the budget. So they said, okay, we will exclude reserve fund contribution, we exclude building maintenance repairs, and the remainder equates to 74%. So 74% of this scheme's budget is for admin costs. So what we will do is we will say, of the 123 that we raised, 74% will pay for administration costs, and the balance, which is 26%, will go into an exclusive use reserve. And then that reserve will build up, and then at the time that maintenance needs to be done, there will be money set aside, and it can be offset against that reserve which is created. So that third option is what the scheme could do, is they could say, okay, we're raising this 123, however, 100% or all of that 123 is to offset administration costs, and none of it will go into reserve. But when the time comes for repairs to be done to that exclusive use area, we will charge the owner who has exclusive use over that area. So those are the three options: raise nothing, raise something and split a portion between admin and an amount into reserve, or just raise an administration portion and put nothing into reserve, and then deal with it when that repair comes up. Okay, great. Okay, so in terms of comparing a budget between a company and a body corporate, generally speaking, and it's not always the rule, but the services the scheme have, the number of staff the scheme have, the number of times their garden is cut, etc., that generally stays the same. The aesthetics of the scheme stay the same. The services required for the scheme stay the same. So for body corporates, it's a lot easier to do a budget than it is for, say, a company who are planning for growth, planning for more staff coming in, etc. But there's always room to change. So my advice is always, if you know something is coming up and it's not something which has come up, don't fall into the trap of, oh, it wasn't there last year, so we're not putting it in. If you know something's coming up, you've got major expenditure, or there's going to be a change in the service, always let us know, or it'll via the PM, so that the budget can be amended so that we can make a provision for that item. Okay, so the next page, we go through to have a look at the actual budget that we send through to you. So the first, so again, the top is just the header, as I went through with you earlier. Then we show you what was the previous budget for each of the items, how much was actually spent, and then how much is the new budget. So it's quite good because you can then see a picture. What did we plan on spending? What did we spend? And what is the new budget total? One thing to just note under the actual, at the time the budget is actually being done, the year hasn't ended yet. So what happens is we are 9 months in or 10 months in, and we're doing a budget for the new period. So what we do, and if you look at the top here, there's a description of it. It says this budget is a 9-month actual and a 3-month estimate. So we take how much was spent or how much income was brought in over the 9 months, and then we say, okay, we'll take that figure, we'll divide it by 9, we'll multiply it by 12, and that will give us an idea of how much by the end of the year we would have brought in, or how much by the end of the year we would have spent on a particular cost center. So let's take this line item, for example, in under your income. So this is interest on current and investment. So if you remember the previous slide, this column here has suddenly appeared. You won't see that in the documentation that's sent to you, but it is there at the time the budget is done. When the property portfolio managers come to you, they're able to see that column. We just hide it at the time we send it out because of the restriction on space on the page when it gets sent. So previously it looked like that, and that column was actually hidden. So if you look at this line item, which I've highlighted, interest on current and investment, at the time this budget was done, the actual amount, so the year-to-date actual, was 255 Rand. If you take 255, you divide it by 9, multiply by 12, you get 340 Rand. And that's the projected amount for that income line to the end of the year. So all things being equal, they should get about 340 Rand. It's not an exact science. There's a lot of cost centers and a lot of things which won't apply or fill into that rule, but it's the best case scenario. All things being equal, they'll have 340 Rand in interest by the end of the year. And then another 2 columns which you don't actually see when the budget is sent to you is these 2, which show an increase on your previous budget and an increase on your actual. Again, the PM the property portfolio manager will have access to that. And so you could see, for example, in this case, when the levies go up, let's use your unit levy, for example, 3,100 was the previous budget. They raised 3,100. The new budget is 3,227. That equates to a 4.1% increase over your previous budget and a 4.1% increase over your actual. Okay, before we get to the slide, you'll notice under this income for United Villas, they've got the usual unit levy, garage levy. They had the exclusive use parking we saw on that previous page, the 123 Rand. Water recovery, so they bill owners monthly for the water that's used. There's also penalties, and there's also this line item here which says other income, rental Telkom tower. So this United Villas in the corner of, in the sectional title scheme, they have given an area for Telkom to put up a tower for which Telkom pays them a monthly rental to use that area. So in this case, the monthly rental they receive is 3,290 Rand, which is about 40,000 Rand for the year as income. So third-party income like that is taxable. So we're going to just quickly digress for a second and just look at the tax implications of third-party income. So we're looking at, so this is the Income Tax Act 58 of 1962, Section 10(1)(e) of that act, and then there's an interpretation note with regards to what is taxed, what is exempt, what is not exempt. So let's just run through this then. So what is taxed? So third-party income is taxed. Interest received on investment is taxed. Rental on a body corporate unit, rental of roof space for cell phone towers, etc. So if it's a third party, so it's not a member income, if it's a third party income, that's going to be taxed. There's a few exceptions, but we'll look at those on the next slide. Okay, so the definition of levy in that interpretation note, it says, levy or levy income is the amount received or accrued from members for the purpose of funding expenditure relating to their collective interest. So the key there, which is underlined, is from members. So that's where the third party element comes in. You're getting money from a bank. They're not a member of the body corporate. They're giving money for interest held. So that interest which they pay to the body corporate will be taxed. Okay, basic exemption means the exemption of receipts and accruals from all other sources other than levy income up to a maximum of 50,000. So the first 50,000 that the scheme received from third-party income is tax-free. You don't pay any tax on the first 50,000 the body corporate scheme homeowner receive from that third-party income. And then expenses directly linked to the income from that third party may be deducted. So if you have interest, for example, you've got a portion of bank fees. There's a cost involved in transferring money, say, to an investment account, or there's a cost involved from the auditors when they're auditing your accounts. They're also going to audit your investment account for which you're getting interest, for which you're going to be taxed. So a portion of your audit fees can be deducted from that before you take off your 50,000, which is exempt. Okay, so receipts and accruals qualifying as levy income. So things which a scheme will not be taxed on will be your normal levies, special levies, building penalty levies. So it covers the cost. So if some schemes have clauses in there, whether it be in their memorandum of incorporation or in their rules, to say if a unit hasn't been built, we're going to give a building penalty on that undeveloped earth in order to cover things like extra security, repairs on roads, because you're going to have trucks coming through. So if you don't build your unit within a certain time, we're going to raise a building levy, building penalty on your earth, and that penalty will be exempt from tax. And then a stabilization fund levies, those are also exempt. So stabilization fund levies is where homeowners associations charge a commission. So they'll say on sale of your unit, 1% or 2%, depending on where you live, or it depends on the percentage which was in your founding documentation, must be paid as a commission towards the stabilization levy fund. And that amount will be exempt from tax. But there is a few caveats to that. And one of the caveats is the fact that the founding documents of the scheme must state, and where that commission is charged, or in the founding documents, it must state that the funds are being raised for a stabilization fund, so to offset costs in the scheme for repairs and maintenance, general, etc. So quite often we find schemes have a clause to say 1%. When you sell, 1% should be paid over to the scheme, but they don't specifically say that this fund is a stabilization fund. So sometimes the auditors don't include it or include it in the tax calculation for it to be taxed, because of the fact that SARS is has a very strict note there to say the founding documents must state that the commission raised is for a stabilization fund. So if it's not in your founding documents specifically mentioning that, auditors will include it in your tax. Okay, and then receipts and accruals not qualifying as levy income. So things that you will then be taxed on. So you've got fines. So this income is not related to expenditure incurred or to be incurred in relation to common property. So you find an owner for noise that they've done, or whatever the case may be, so that will be included in your tax calculation. It will be a taxable income. Late payments, so interest charged to owners for paying late on their levies, or any other penalties or late payment fees that you charge to them, that income will be taxable to the scheme. And then finally, all other income from a third party, i.e. non-member income, like we said earlier, bank, rental, common property, to a non-member, unless specified elsewhere in the Act. Okay, so that's the tax. We'll take all your third party income, your interest, your fees, your penalties. We then take off the expenses which we are able to take off, less than 50,000 times 28%. So the balance will be charged at 28% to get how much tax you will pay for that. Okay, so let's continue with the budget then. So that was the income section. Further down, we now move on to your expenditure section. So again, the same rules apply. We group your expenditure as best we can into administration costs, your building maintenance costs, your employment costs are grouped together. So we try and group them as best we can. And again, the same principle. What was your previous budget? How much have you spent year to date, plus the 3-month estimate? And then what is your new budget? And then we can tell how much how much of that is an increase over your previous budget and how much of that is an increase over your actual. So let's look at your legal collection fees, for example. The previous budget was 372 Rand for the year. It was not spent, but in the new budget, it's 408 Rand. So again, don't, just because it wasn't spent, don't look to remove that cost center. It's the same thing with repairs and maintenance. If you've got repairs and maintenance, plumbing, for example, you've budgeted for it, you didn't use that budget cost center, still keep it in if there's a likelihood of it coming up in the future. And then employment costs, staff welfare is another one. They had a budget, it wasn't used. Maybe they didn't need uniforms, they didn't need new boots, they didn't need any safety equipment or anything like that, so you didn't spend it. So if you plan on doing it or you think it's likely to come up next year, put it into your budget. Okay, board expenses. So here's another cost center. So in this case, it's miscellaneous, but again, if you require us to, and if the need arises, especially if it's a much busier scheme, we can split it up into board expenses, printing and stationery, board expenses, travel, board expenses, telephone. In this case, there's only the one cost center, but like I said, we can split it up. This is a useful cost center for trustee expenses. So where trustees are doing printing on behalf of the scheme, where trustees are doing travel on behalf of the scheme and want to claim that back, it will go into those cost centers. Okay, then building maintenance. If you look at the electrical, this is another example of, don't necessarily look at what you did last year to get your new budget for this year. So previously, they budgeted to spend 1,200 Rand on electrical in the year. They actually spent 12,000, which, if all things being equal, will be 16 by the end of the year. In the new budget, they've left it at 1,320. This major expenditure here might have just been for a once-off new meter or something like that. So you don't necessarily need to just increase on your actual. You can also just apply your mind that actual was particularly high because of a once-off event, but we don't anticipate it happening. So just apply an increase. In this case, it's a 10% increase on the previous budget, even though it's a 91%, it's 91% under what they actually spent. If you can apply your mind to it and at least explain that way, then it'll make sense. Okay, fire equipment. This is a good one for trustees to just be aware of. If you do have fire equipment that needs to be serviced annually, it's always a good indication when the budget comes. And quite often, if especially dependent on where your year-end lies, but if you haven't had your inspection yet, this cost center will be nil. So you haven't spent anything on fire equipment, but you also need an annual inspection, and that's a requirement from your in terms of your insurance policy. So if you see this as blank, it's always a good thing, and we always say to the property portfolio managers, there's no expenditure here. When is, a reminder, when is the next inspection to be done, and please make sure that that happens. Okay, great. And then just another cost center we can look at, workmen's compensation. So this is one of those cost centers. If you have employment costs, will be in your budget. And again, even if you don't have a full-time employer, so somebody's not on payroll, you just use a casual worker, workmen's compensation will be in your budget, and schemes should register for workmen's compensation. Remember, if you have somebody who works more than an aggregate of 24 hours in a 4-week period, then it's compulsory for the scheme to register for workmen's compensation. So that works out to more than, considering an 8-hour day for a full time. So if they work more than 3 days full time in a month, you should register for workmen's compensation. And even like I said, if you got casual wages, register for workmen's compensation. And if there's anything was to happen to that person whilst they were on your property, then the body corporate will be covered, that person will be covered. And if they permanently disabled from an event or partially disabled, then workmen's compensation will pay them out. And then just as an interesting side here, the minimum payout will be 1,626 up to a maximum payout of 12,624, and that's calculated at 75% of their normal income or their usual income, and then obviously a disability factor. So somebody, an event happened, they're 50% disabled, unable to work as much as they used to, so it would be 50% of what they used to earn times the 75%, and then obviously within that threshold, they will get compensated for the rest of their life or for the duration of that permanent disability period. Okay, so let's carry on working down the budget. So we've got more cost centers for United Villas, insurance excess. So this is R1,000 for them. Most policies have a general excess of R1,000. Some I've seen have maybe R500, but generally it's 1,000. So this is one of those cost centers you wouldn't necessarily just apply a 10% increase to. It's a general excess is 1,000, so it would go up in multiples of 1,000. So it'll be 1,000, 2,000, or 3,000. You're not going to apply a 10% there. Movable property assets have a cost center for things like signs, warning signs. I mean, this has been used quite a lot this year on a lot of our schemes because of the COVID and putting up warning signs and information signs, etc. So have a cost center like movable property assets. We will put it in automatically every year. If you ask us to take it out, we will. But we'll prompt you and say, look, it's a good idea to have something like this. Pest control services, again, it's a good idea to have a budget for this. To maybe get rodents treated or flies, or whatever the case may be on the common property. So again, we'll prompt you every year to put this in. If you want us to take it out, we will, but when we send you the draft, that will be in. Okay, reserve fund provision, we're going to talk about that now. That will be our last section of the budget coming up with regards to how to calculate the minimum, etc. So that's the next thing. Client internet portal, watch the space. I know a lot of you have been looking there thinking, is that splodge getting bigger? It's not getting bigger, but it's just to note, we are doing some development, software development. It's really exciting. There's going to be new features. We're going to have an app which you're going to download from Play Store, etc. It's going to be linked in. It's a whole brand new portal which is coming up. So do watch the space. There's some exciting things going to be happening there later on this year. Okay, and then finally, your utilities at the end. It's in alphabetical order, so you will be at the end. Water and sewage, always apply your mind to this cost center. And I always say to the property portfolio managers when they look at this, if you know a particular incident happened in the year with regards to, say, a leaking toilet or a burst pipe or something like that, and it pushed up your actual, don't budget for a water leak. So don't go and apply an increase on the amount that you actually spend. So always look over the year that's gone and say, okay, was it a normal year for usage for water and sewage? And if it was, then by all means, make the increase based on your actual. But if it wasn't and there was a specific event that happened, don't look at the actual, rather put an increase on your previous budget, so that even if that problem hasn't resolved itself, there's a couple of schemes who have ongoing issues with underground water leaks. So every 3 months or so, it's a plumber coming out to try and trace a leak and fix a pipe, and that's as a continual basis. Don't, in those circumstances, increase on your actual, rather increase on what you expect that scheme to be paying, so that it's not hidden. Because what happens is a change of trustees happens, say, every now and then. You then go and put an increase on how much was actually spent, which is a high amount, which included water leaks. When you're looking at your management accounts, like we discussed a couple of weeks ago, you won't see that variance. You won't see that suddenly you're overspending on that budget and then it gets hidden, and then suddenly nobody's investigating why the water is so high because you budgeted for that high water. So do apply your mind to it. And then finally, you had your income at the top, you have all your expenses, and your budget should have a nil variance. We did discuss this in the management account webinar. It should have a nil variance. There are exceptions to that. The trustees are limited to increasing the budget by 10%. If the trustees require a higher percentage than 10%, what they do is they then take it to the AGM and say to the owners, okay, so they implement a 10% budget, go to the AGM, and then they put the case forward to say, we need a 28% or 30% or whatever the case may be, because of the maintenance plan which has been revealed to us, or because of this work which needs to be done, etc. And then the owners at the AGM will then implement the 28% or 38%, whatever is required at that stage. So generally speaking, there wouldn't be a variance here, but like I said, there is an exception where trustees are perhaps limited to how much they can increase your budget by. Okay, and then now let's go to our final section, which is where we look at your reserve fund calculation and your minimum reserve. So the minimum reserve fund calculation in terms of the regulations to the Sectional Title Schemes Management Act 8 of 2011. The Sectional Title Schemes Management Act 8 of 2011 stresses that one of the functions of the body corporate is to establish and maintain a reserve fund. In such amounts are reasonably sufficient to cover the cost of future maintenance and repair of common property, but not less than such amounts as may be prescribed by the minister. So in effect is saying you should have a reserve in order to cover your future maintenance repair plan, but also the contribution mustn't be less than what's prescribed by the minister, which is what we're going to look at now. Okay, so under the Sectional Title Schemes Act of 95 of 1986, owners in the scheme could determine the provision to be made for the reserve and determine increases if they wanted them. However, the new Act now places a statutory minimum contribution on schemes in accordance with what they currently have in their reserve. So we're going to look at a calculation there as an example. So before we look at the calculation, what is the goal? What does the Sectional Title Schemes Management Act, so this won't apply to homeowners associations, but what is the goal what is CSOS's goal for every scheme to have? So the goal is for every scheme to have at least 1 year's levy or administrative or operational budget in their reserve. So whatever your annual operating budget is, that is what CSOS would like you to have an equivalent amount in your reserve. The administration fund is simply your scheme's budgeted expenses for 1 year, excluding the reserve fund contribution. So that's your operational budget. How much does the scheme spend on expenses in a year? That's the goal. That's what you need to be aiming to have in your reserve fund. Okay, so the Act says, or you need to look and see what you have at the end of the year, at the end of your financial year, in order to determine what is the minimum contribution for your coming year. So now the problem comes in is that we're actually here. So our year, so here's my financial year. So it's run from the 1st of November 2019, and it runs all the way along to the 31st of October 2020. So the year hasn't ended yet, so we don't actually know how much we're going to have in our reserves. We're actually 3 months or 2 months, in this case, United Villas, you saw how we were 9 months into the year, we still had 3 months to go. So we don't know how much we will have at the end of the year. So how then do we determine the minimum? So what we need to do is we need to say, okay, well, what do we know? Okay, what we do know is we have a set of audited financials from the previous year. That's great. So that set of financials from the previous year will tell us, or will let us know how much we had in our reserve fund and our general fund. So it'll say you had X amount. then to that amount that we get from our previous year's audited financials, we can add how much we anticipated to put in our budget. So we knew, if I go back a few slides, we knew in our budget, we wanted to put in 10,968 Rand into the reserve fund. So we can take the amount that the audited financials said we had, and we can add that 10,000 odd that we budgeted to contribute. Then we can less any expenditure for the year from that reserve fund. So we're 9 months in and we know how much we've spent to date or how much we anticipate on spending before the year is up. So we can take our audited financial total, add how much we're contributing to our reserve for the year, less how much we anticipate to spend by the end of the year, and that will give us a best estimate of what we will have at the end of the year. So whilst we can do this, and like I said, it'll be a best estimate, by the time the AGM is done, we can actually review, because when the AGM is done, the budget is ratified for the year, so you're already a few months in. But at that point, we can just look again and say, okay, well, we thought it was going to be this. Let's look at the audited financials. How much was it? How much did it end up being? Is there a major change? Have you changed? What was the new percentage? Where did you fall in those brackets? And then you can make an adjustment accordingly at the AGM. But at the time of the budget, we just have to do a best estimate of what we will have when the year end comes up. Okay, so let's do a practical example then. Okay, how is the minimum contribution calculated? Right, the first step is to look at the previous year's budget. So, like I said, the image shows the calculation of the administration fund for United Villas taken from last year's budget. So we look at the budget. Their total income was this 91,476 Rand. That was the total income. As an aside, we can actually deduct the water variables. That's a charge which is going to come in from the municipality, be charged to the scheme. So we don't need to include this 11,000 Rand, which is the variable income anticipated to come in. And then we take off the annual reserves, in this case 10,996. Remember, what we're trying to determine is what is the goal, what is CSOS's goal for this scheme to have? And their goal for United Villas is to have 1 year's levy. So in this case, they've got, what is their 1 year's levy? What is their 1 year's operational budget? So it's the total there, the 91,476. We can exclude the water because that's a direct charge from the municipality to them. And then we can exclude the reserve fund. Remember, reserve fund is not going to be spent in the year. It's not part of the administration portion. It's not part of your operational budget. So we take that, less the water variable, less the reserves to get your administration portion for the scheme. So in this case, the Act would like United Villas to have 68,628 Rand in their reserve fund. So that's United Villas' goal, to have 68,000. Now we need to look and see what do they have. So let's go to the next slide then. If you look at their audited financials from last year, like I said in our timeline, the audited financials from the previous year said they had 42,120. The general fund in the audited financials actually said 15,230. And if you remember from the management account training, we said a portion of this, the general fund is not particularly earmarked for the maintenance plan or anything specific, and is not necessarily governed. So we can decide how much of that is going to be considered as part of the reserve, and how much of that is going to be used or not ring-fenced for it. So the trustees, for example, can go over budgets, etc., in certain cost centers. So that stems from the management account training that we had. So in this case, although they had 15,000, they said, okay, 5,230 will be part of reserves, and 10,000 will remain in the general fund for overspend on budget. So 42 plus the 5. And then we've got how much did they put into the budget. So if you look under the actual column, they budgeted to put in 10,968. The interest was 333, so we add that. So altogether, they have the 42,000 plus the 5 plus what they put in this year to give us a best estimate. So this is our best estimate of what they will have, 58,651. Right, so how does that equate? So they got 58,551.33. Remember, CSOS wanted them to have 68,628. That equates to 85% of what CSOS would like them to have. So they're at 85% of their goal. Right, so now that we know that United Villas is at 85% of the goal, what does it mean? What is the implications for them? So CSOS give you 3 brackets that you fall in. You either fall in 0 to 25% or less than 25%, or you fall in between 25 and 100% of the goal, or you're more than 100%. If you're less than 25%, CSOS will say your minimum contribution needs to be, your minimum contribution in your new budget will need to be 15% of your administration fund. So when you're doing a new budget, because you're less than 25% of your goal, you need to budget 15% of your operational budget should be going into reserves. If you fall in this bracket, 25 to 100, then whatever the scheme expects to spend on repairs and maintenance in the year, they must put an equivalent amount into their reserve. Now, that's kind of iffy because you might get the odd trustee who's hell-bent on keeping levies down. He can say, well, I anticipate on spending nothing. So yes, technically in terms of the Act, your minimum requirement will be nothing. But he would be hard-pressed if he was challenged to say, look, well, that doesn't follow any of the trends which have happened, in the years leading up to it. Why have you done that? But generally, if you're between 25 and 100, then whatever the scheme are budgeting to spend on repairs, an equivalent amount should be budgeted for their reserve. And then if you're more than 100%, so if they had what CSOS required them to have, then no minimum would be imposed on them. And then again, that is obviously subject to the being able to meet your requirements in terms of the 10-year maintenance plan without raising a special levy. Okay, and then, just from this slide, I know we're conscious of time, we've just got 2 more slides to go through. So the idea, like I said, is the idea behind making sure that reserves are in place is to help owners in preventing and reducing the requirement to pay special levies, which they may not be prepared or being able to afford when the time comes. So that's the whole purpose of this exercise. Right, okay, so let's wrap up this section. So we've got total expenses of the scheme, you've got your reserves, their new budget is 73,296. In the documents we send to you, we say, okay, how much is the repairs and maintenance for the scheme? So in this case, all the building maintenance repairs add up to 10,620. So we put that figure in. And then we also say, just so you know, for your information, so if your reserves are less than 25%, your contribution has to be 15% of the admin fund. And for your scheme, this means 10,940. If you're between 20 and 100%, whatever you're spending on maintenance, so this 10,620. So we just show you both scenarios, but we say, we know that in this case it was 85%, so reserves must be a minimum of 10,620 because they fell into this bracket. And what is the reserve in their new budget? Here it is, 11,364. So they are compliant. They're required to put a minimum of 10. They are putting 11, so they are compliant. So that's the last sheet that we include in our budget. And then finally, every scheme is required to have fidelity cover insurance. It's actually really easy to calculate what you need to insure. Remember, fidelity cover, it's against crime, internet fraud, someone running off with your money, etc. So the community schemes, investments and reserves at the end of the financial year, so that's 68,000 that we've been seeing a lot throughout. So at the end of the year, we anticipate that they had the 68,000 in their reserves, plus 25% of their anticipated income for the new year. And then in this case, you add those together, and that's what CSOS require the scheme to have as fidelity insurance. And this requirement is not only for sectional title schemes, but it's also for the homeowners associations. And that's it.
Jason, thank you very much. I'm sure you will all agree with me that the information shared by Jason today in unpacking the budgets, as well as the levy schedule, is vital in understanding the financial documentation relevant to community schemes. And I again would encourage our viewers to please go look at the management accounts as discussed by Jason and the audited financial statements as discussed by Hayden du Preez. Valuable information has been shared and it will assist you in the effective and efficient management of your scheme relevant to the finances. We really do not have much time for questions, but Jason, I'm going to put one question to you other than why did the auditor cross the road or the street? Just want to quickly ask a question that's been put to us relevant to if the trustees at an AGM propose a levy increase in excess of 10%, in other words, if they go to the members and say, you know what, we need 27% or 30%, are the members of the body corporate compelled to accept that proposed budget put to them by the trustees at the AGM?
Okay, so the idea behind the trustees taking it to the AGM is for them to advise the owners that, you know, this is the requirement. If the owners at the AGM can point out things or cost savings like don't, you know, put new signs in or don't, you know, maintain the jungle gym or whatever the case may be, if they can, you know, they can say to the trustees, okay, cut out these elements in your budget, and then we can get to, you know, the 10% that we're currently paying, or reduce it, you know, instead of a 28% down to a 15%. But remember, the obligation and the fiduciary responsibility on the trustees is to maintain the common property. So fair and well, the owners may take the resolution to say, look, we're not going to put a 38%, we're only going to go with 15 or 12 or leave it at the 10. But during the year, if maintenance comes up and it hasn't been budgeted for and it was unforeseen, you're going to run the risk of either having to use a reserve in that scenario, or the trustees will actually be compelled to raise a special levy, and then they actually won't need the owner's permission. So whilst the owners can say, we'll only approve 15% or 12%, when that maintenance does come up, then the trustees would then be compelled to raise a special levy for that unforeseen expenditure that happened in that year.
Yeah, thank you very much, Jason. There's also a question put to us relevant to an owner being in a fortunate position to pay more levies on a monthly basis, thereby accruing a relevant, sufficient or substantial credit on his levy account. What are the trustees to do in such instance? I suppose the owner would want to attract interest on the amounts paid in advance.
Yeah, so the scheme isn't a financial institution, so it can't give interest on monies held. However, the Act does allow, if a resolution is taken as such, to give a discount on levies. And it gives, you know, so if the scheme take a resolution to say, or they can take a resolution to say, you know, at the time the budget is set, this is the budget, we're going to give a discount to owners who pay in advance, and, you know, 5%, whatever the case is. So owners who do can then benefit from that discount. But, you know, an owner who takes it upon themselves to just pay in advance randomly throughout the year, interest cannot accrue because the scheme are unable to pay interest in terms of they're not a registered financial institution. But they can give a discount if it's a resolution that the scheme have taken, you know, to offer discounts for levies paid in advance.
Yeah, thank you, Jason. I think what is also very important here is that trustees must be very mindful not to spend levies paid in advance, and they must look carefully at the management account sent to them where it's set out and shows the prepaid levies. So just be mindful, it's not money that you cannot spend that money. The money needs to stay in the account for the end of the current fiscal period. I think that really wraps up our webinar today, unpacking the management accounts. And again, as I said, I'm sure you found it very, the information shared useful, and that you will be able to apply going forward. And please share the webinars with your community scheme members so that they can also understand the audited financial statements and budgets that are sent out. Thank you very much. And the next webinar, just very quickly, we will be hosting another webinar on the 10th of September, where we will be talking about or discussing executive management. And then we will be hosting one again on the 17th of September, where we'll be discussing 10-year maintenance plan. And for that discussion, we have invited Paul Adams from Curasure to discuss their turnkey options. And again, I'm sure you will find those webinars insightful. Thank you very much and keep well.
Thank you.